Hello everyone, welcome to the 141st episode of me learning how to trade in Forex. So in the last episode we went through controlling emotions that hold you back. Basically there's two types, or we went through two main emotions I guess. So anxiety and doubt, basically good to be cautious and considerate in your trading, but if your worries are crippling you, that's counterproductive. So the transition to a live trading account after using a demo account is one of the steps that worries some traders. So there are, however, things you can do to make it a little bit less daunting. So for example, reflect on the lessons you learned while using the demo account, apply the same strategies that brought you success in demo trades, follow a trading plan, start by trading small sizes until you feel comfortable, and use risk management tools such as stop losses. And as long as you trade sensibly, use the skills and knowledge you've already gained and keep your position modest, there's every reason for you to expect success. Of course, everyone's going to make mistakes, we all do, but by managing risk carefully you'll minimize your losses from the mistake. And then there's also a fear of loss. So it's when a position is moving against you and you begin to see a growing loss. So if you see that happening, you start to feel nervous. Should you close your position now and cut your losses, or should you adjust your stop losses? So before doing any of that, ask yourself, was my original analysis flawed? Have circumstances affecting this market changed since I opened my trades? And did I place my stop at the wrong level? If everything suggests your original analysis is still valid and you positioned your stop correctly to protect yourself from unacceptable losses, there's no reason for you to alter or kill your trades. Have confidence in your original judgment and let things play out. Your loss could turn into a profit. And then we went through the lesson summary of this. So now we're on to controlling emotions that entice you to trade. So controlling emotions that entice you to trade. So while some emotions can make you hesitate to trade, others can have the opposite effect, causing you to act when you really shouldn't. Impatience. Rather than being paralyzed by nerves, some new traders have quite different reaction and can't wait to jump into markets. This can be even more damaging. So as the saying goes, a little knowledge is a dangerous thing. A little knowledge is a dangerous thing. And launching yourself into a trade before you're fully prepared is a sure route to disappointment. First, consider this checklist. Are you ready to trade? So ask yourself, whoa, no caps. Ask yourself, are you ready to trade? Are you comfortable using your trading platform, and do you know how to apply the tool it provides? Are you comfortable using your trading platform, and do you know how to use the tools it provides? Have you created a trading plan? Do you fully understand all the factors currently affecting the market you want to trade? Do you fully understand all the factors currently affecting the market you want to trade? Have you planned your trade? You planned your trade. Considered your objectives. And calculated the potential profit and loss. Calculated the potential profit and loss. If you can answer yes to all these questions, and if your proposed trade fits your trading plan, you're ready to go. Similarly, exercise restraint when it comes to open positions. After entering trade, you should give the market time to react as you expect it to. Don't get impatient and trade out before the market's had time to move. Exercise restraint when it comes to open positions. After entering a trade, you should give the market time to react as you expect it to. Don't get impatient and close the position before the market has time to move. Temptation and greed. When your trades are going well, it's only natural to be excited about the potential for even greater gains. But at these moments, it's vital to stick to the rules of your trading plan. If the signs indicate it's time to close the trade and take your profit, it's probably not a good idea to keep holding on to the hope of making even more money. The same goes when you're seeing an enticing opportunity to trade. Suppose you know an experienced trader who tells you he thinks Trendy Online Retail Group PLC is about to see a surge in its share price. You might be tempted to place a large trade even if it goes against your trading plan. But it's important to remind yourself that your plan is there for a reason, to take the emotion out of trading decisions. If the risk posed by this trade is outside the parameters you would normally consider, you should decline to get involved, however convinced your friend may be. Stick to your trading plan, even if everything goes well. Don't be hungry for more profit. Close your trade as shown in your trading plan. Happiness and pride. When the trade goes well, you're likely to feel a surge of pleasure and satisfaction. Naturally, you'll be proud of your achievement, and if a series of trades all turn a profit, you may even start to feel invincible. These emotions, although positive, can also be dangerous. At times like this, irrepressible optimism can set in, and encourage you to take risks that normally be outside of your comfort zone. We humans tend to see patterns in everything, so a sequence of successful trades may convince you that you are on a winning streak. However, remember the universe doesn't work that way. Your next trade could just as easily result in a loss, so if you overcommit yourself, you could be in for a painful shock. Always be aware of the way your mood is affecting your trading decisions. By controlling your excitement, staying calm, you're more likely to think clearly and make informed, prudent choices. When you have a series of successful trades, you may feel invincible. However, this can be dangerous as irrepressible optimism can set in. Encouraging you to take risks. Why is it not capitalizing? Encouraging you to take risks that would normally be outside your comfort zone. That would normally be outside your comfort zone. However, that normally be outside. However, remember that your next trade could easily be a large loss, which could cancel out all your profits beforehand. There we go. So always be aware of the mood, of the way your mood is affecting your trading decisions. By controlling your emotions and staying calm, you're more likely to think clearly and make informed and logical decisions. Cool. Lesson summary. Sensible restraint is vital. Don't trade impulsively without really knowing what you're getting yourself into. If an opportunity doesn't fit your personal trading plan, say no. Don't allow success to go to your head. Enjoy your achievements, but stick to your trading strategy. Yep. Next one. Controlling emotions that cloud your judgment. So, some types of emotion can affect the clarity of your thinking and so impact any trading decisions you make. Anger. A losing trade can make you furious, often simply with yourself or for making a bad decision. But we all make mistakes. It's an important way to learn. If it happens to you, as it inevitably will one day, put it down to experience and make a mental note about what to do differently next time. One common impulse in moments of anger is to try and get back at the market by placing another trade. This sort of knee-jerk reaction or hair-trigger trade is nearly always a bad idea. Alternatively, you might just start buying anything and everything indiscriminately. This is known as shotgun trading. Take a moment to sit back and breathe deeply, then consider objectively whether your proposed trade really makes sense and is in line with your overall trading strategy. So, anger. A losing trade can make you furious, but we all make mistakes. This will inevitably happen. So ensure you learn from this experience. And think about what you could do, what you can do differently next time. Don't try to get back at the market by placing another trade. Take a moment to sit back and breathe deeply. Regret. Another common source of annoyance is missing an opportunity, something that's easy to do in the fast-moving world of financial markets. When this happens, it's easy to give yourself a hard time about it, repeating things like, I should have bought here, or I knew that was going to happen, but this sort of mentality can lure you into traps capable of undoing all your hard work at a stroke. You might, for example, be tempted to place a belated trade anyway, or to risk placing a number of trades in quick succession, known as overtrading, to set things right. You might even go on a tilt, a particular state of mind which means you make irrational decisions rather than those based on merit of what's right in front of you. That's why if the moment has passed, you need a few tricks to remain clear-headed until the next signal comes along. Fortunately, those tricks are as simple as taking a break, casting an eye over your original trading plan, and exercising a positive mentality. Remember, missing a move is not the end of the world. True. Annoyance from missing an opportunity. if the opportunity moment has passed, don't be hard on yourself. Wait for the next opportunity to come along. Whilst waiting, take a break, reread your trading plan, and be positive. There's always other opportunities coming up. There's always other opportunities coming up. Missing one is not a big deal. Sentimentality. Suppose you've traded gold several times and each time you trade you made a healthy profit. It might be tempting to start believing, perhaps subconsciously, that gold is your friend and that it will reward you in the same way every time. Once this conviction grows, there's a danger that you open further positions in gold without properly considering the current situation. Unfortunately, the fact that a particular instrument has been profitable to you in the past is no guarantee that it will continue to perform for you. But likewise, if you had a bad experience with a certain asset, there's no reason to shy away from any future opportunity it offers. If a particular financial instrument has been continuously profitable for you in the past, it may lead you to subconsciously believe that the particular financial instrument is your friend and that you'll always profit from it. However, even though it has been profitable in the past, it might not always be profitable in the future. Also, if you've had a bad experience with a certain asset, don't shy away from new opportunities. Don't shy away from any new opportunities it could offer in the future. Stress. There are times in all of our lives when events beyond our control affect our ability to think clearly. It could be divorce, family illness, bereavement, or just moving house or changing jobs. All of these things will distract you from trading and could cloud your judgment. The world of financial trading can be hectic, demanding your undivided attention. So when you're going through stressful periods, it's often safest to put your trading on hold until you can commit the necessary time and energy to do it again. The world of financial trading can be hectic and demanding of your time, of your attention. If there are moments in real life which could affect your ability to think clearly or cloud your judgment, when you're stressful, it's often good to put your trading on hold and come back again when you can. Commit the necessary time and energy. And mindset to do it again. Cool. Lesson summary. Don't beat yourself up about poor decisions or missed opportunities. Learn from your mistakes and look forward to getting it right next time. To avoid going on tilt when things go wrong, take a break, remind yourself of your trading plan, and wait until you're back in a positive state of mind. Remember that sentimentality and superstition have no place in trading. No market is your friend or enemy, and every opportunity should be assessed upon its merits. No market is your friend or enemy. No market is your friend or enemy. When you're suffering from stress in other areas of your life, it may be wise to put your trading on hold. Cool. Developing an unbiased positive approach. Developing an unbiased positive approach. Sometimes your patterns or behavior come about as a result of subtle influences. A bias can affect your judgment to such an extent that your decisions might go against all conventional wisdom. A bias can affect your judgment to such an extent that decisions might go against all conventional wisdom. A bias can affect your judgment to such an extent that your decisions might go against all conventional wisdom. Everyone has biases. They play a massive part in everyday life. You may buy a certain product at the supermarket because it's a brand you recognize, or read a particular newspaper because it backs up what you already believe. There's no way to get rid of biases altogether, but if you're aware of how it may manifest itself, you stand a much better chance of minimizing the impact on your trading. Representative bias. Let's say you've been watching a market which has been recently followed an uptrend. You take a position which on this occasion pays off. At a later date, you see the same market following an almost identical trend. Because of the representative bias, you assume that if you make the same trade again, you repeat your success. But even if your two trades seem similar in the surface, it's key you treat every circumstances as unique. Different bias types. So representative bias. So just because something which happened in the past has now appeared in the present, it doesn't mean the present trade is a repetition of the past trade. Even though the situation is similar, it's vital to treat every circumstance as unique. Negativity bias. Looking back on a past trade, you might only see what went wrong. A particular tough loss or series of losses will cause you to overlook any positive result you've had, and the equally positive decisions that led to them. Looking back on a past trade, so this is like only when you see negative side of things, not the good side of things. So you might only see the negative side of things, which will cause you to overlook any positive results you've had. And the equally positive decisions which led to these results. Gambler's fallacy. If a market goes up for 3 straight days, gambler's fallacy is that it is likely to go up on the 4th. But beyond your own imagination, there's nothing to link events of the past to events of the future. There's nothing which could link the past events to the future events. I.e., if something happens for 3 straight days, it doesn't mean the 4th day will continue. It doesn't mean the 4th day will continue have that something happening. Status quo bias. Instead of looking for new ideas, you might be inclined to use those that have proved successful in the past, even if objectively they're no longer worthwhile. So you're basically stuck where you are. You're not really looking to improve on what you've got, even though objectively the new method is going to be an improvement of the old one, but you just don't want to change basically because you're too stuck on the current meta maybe. Instead of looking for new ideas, you might be inclined to use those that have proved successful in the past, even if they're no longer worthwhile objectively. Confirmation bias. Maybe you're confident in the stock market. Maybe you're confident the stock market is going to rise. With confirmation bias, you only see the news information that supports your view, and gloss over anything that contradicts it. So you only see the news and information which supports your view, but gloss over anything which contradicts it. Loss aversion bias. You won't close an unprofitable position, holding on to trade in the hope that it will end up paying itself off. This is similar to endowment bias, where you perceive those trades you've made as having a lot more potential than those you decided not to make. Where you perceive those trades you've made as having a lot more potential than those you decide not to make. In both cases, when the price moves against you, you'll be reluctant to let it go. You won't close an unprofitable position, holding onto it in the hopes that it will turn profitable. If price goes against you, you'll be reluctant to let it go. Herd bias. It's human nature to do exactly what everyone around you is doing, and the traders are as acceptable to this as anyone. Are as susceptible to this as anyone. You need to have the confidence to make decisions based on your own research and trading plan, and to stick to those decisions when you've made them. Around you is doing. Traders are as acceptable to this as anyone. Don't follow what everyone else is doing. Have the confidence to make your own decisions based on your own judgement, based on your own research and trading plan. Stick to those decisions once you've made them. So what is endowment bias? Endowment bias. So endowment bias. You perceive that the value of the item you own is higher. You perceive that the value of the item you own is higher than if it didn't belong to you. Yep. Okay. So when you perceive those trades, so reluctance to let go, you can, where is it? You perceive those trades you made as having a lot more potential. So you perceive those trades. This is the wrong one. You perceive those trades as being more valuable, right? As having more potential than those you decided not to make. Therefore, if price moves against you, therefore if price moves against you, you'll be reluctant to let it go. Therefore, if price moves against you, you'll be reluctant to let it go. Cool. The emotion traits of successful traders. In this course so far, we've looked at how to control emotions that can be harmful to traders. So let's now consider which personal characteristics you should aim to develop if you want to get the best out of your trading. Question: which of the following words are likely to describe a successful trader? Decisive, self-aware, disciplined. Yeah. When you're in the thick of the fast-paced financial markets, a cool head and disciplined approach will serve you well. You need to be ready and react quickly and decisively, but only when the opportunity is right for you. Know your skills and limitations, know what you want to achieve, and always be guided by your trading plan. So, keep a cool head and have a disciplined approach. You need to be ready to act quickly and decisively. But only when the opportunity is right for you. Know your skills and limitations. Know your skills and limitations. Know what you want to achieve. Know what you want to achieve. And always be guided by a trading plan. Always follow your trading plan. So let's a summary. Be aware of biases and learn to recognize when it might be affecting you. We all tend to think in certain ways, but try to stay as objective as possible when you're placing a trade. Try to stay as objective as possible when placing a trade. Successful traders are generally calm and disciplined. They know their own limits and they follow a clear plan to reach their trading goals. Be aware of biases and learn to recognize when it might be affecting you. Be aware of bias and learn to recognize when it might be affecting you. Cool. I'm going to leave this episode here then. So in the next video we're going to go through common trading mistakes part 1. So thank you all for watching and I will see you guys in the next video. Bye bye.